Cocoa prices are skyrocketing. Natural gas prices are crashing. The price of Bitcoin can skyrocket and crash all in the exact same day. Even real estate prices last year went up. This year they're coming down. I think we have gone into a volatility super cycle. And I'm going to explain this to you and how it will impact your portfolio in 3 simple, fast steps. Step number 1, let's go over the low float effect. This is a chart that I just drew just to give you a visual to understand the concept better. This chart is pretty much the foundation for the entire video. So let's go through this very simple concept quickly. This hypothetical chart goes back to 2020 to today's date. On the left, we go from 0 up to $5. Now, let's just say this represents shares or the stock price for XYZ Corporation. And let's also say that XYZ Corporation has issued 1 million shares into the market. So the float, or the available supply of shares to actually trade back and forth, is 1 million. Okay, now we'll start with this blue line. Going back to 2020, you can see the hypothetical price pretty much stays the same. It doesn't really fluctuate. So what the price is telling us is that there is an equilibrium between the supply and the demand. So if the supply is 1 million shares, the demand is for 1 million shares. But what happens if you add an additional 10 shares? So the company comes out and says, we need to raise more money, so we are going to issue 10 more of these pieces of paper, or what used to be pieces of paper. So now, instead of the float being 1 million, now it's 1,000,010. What do you think that's going to do to the share price? Most likely nothing. Why? Because 1 million is a lot bigger than 10. 10 shares is just a drop in the bucket when you look at what number you're starting with. But now let's go through this thought experiment one more time. And instead of the float being 1 million, let's just assume the float is only 10. Same thing. Price stays the same, represented by this blue line. But now the company comes out and adds 5 additional shares. What is that going to do to the price? The price is going to plummet because we're only starting with 10. And therefore, if you add 5, you go up to 15. That is a huge percentage increase, even though the demand stays the same. Okay, but now let's look at the flip side of the coin. Assume that instead of supply increasing by 5, demand increases by 5. Well, you're going to have the exact same thing, but in the opposite direction. Instead of the price tanking, it's going to go parabolic. So the exact same company with the exact same fundamentals that had a large supply of shares for sale would likely have a price chart that looks very similar to this blue line, where if they reduced the supply to a significant degree, their price chart would look more like the red line. But it's not just publicly traded companies. It also applies to the real estate market when inventory gets very low. It applies to Bitcoin when more people are hodling. It applies to gold, commodities, any asset class out there. If we see an overall reduction in the supply or the float, you can expect volatility to increase massively. Editor, let's go ahead and cut to a couple charts of actual publicly traded companies, and we can see this concept playing out in real time. First, let's look at a chart of Apple. They have approximately 16 billion shares outstanding. And over the span of, let's just say 38 days, there was a screenshot here, their price went up by 18%, which actually is a lot. That would be considered very high volatility for that particular stock. But now let's look at a company, ticker symbol EYES. I have no idea what they do, but we're just using this as a good comparison. So EYES has only about 20 million shares trading. And in just 4 days, the price fluctuated by not 18%, not 100%, but 1,293%. Step number 2. So now let's go into the supply dynamics or the float effect for some major asset classes that I'm sure a lot of you hold in your portfolio. We'll start with real estate. And as most of you know, the housing inventory is close to an all-time low. Usually, as according to a Fred chart, we're around 1.4, 1.5 million. So this is how many homes are typically for sale in the United States. You can see in January of 2022, we got all the way down. My goodness gracious, I actually didn't realize that we got all the way down to 346,000 homes for sale. Wow. No wonder we've had some volatility in the housing price. But still, even today, we're at 665,000, less than half what we typically have. So at these numbers, you would expect the volatility in the housing market to be much higher than it usually is, understanding that the volatility in this asset class is typically extremely low to begin with. Now let's move over to the gold market. And this is an interesting chart I found online that goes back to 2021. I wish I could find more recent data. But what we see represented by this blue line is the output from gold miners has been extremely, extremely low. And I would imagine it's the exact same thing today because the share price of the gold miners as a sector has just absolutely gotten crushed, even while the price of gold is going higher and higher and higher. But there's more to the story than just the demand side and how that's impacting the overall supply. I don't know what the hodl rate for gold is. We're going to get to that in a moment with Bitcoin. But I do know there are some buyers of gold that would be more likely to hodl moving forward. What am I talking about? The central banks. Let's go over to another chart that shows central bank buying. And we can see in 2022, it went up to an all-time high, or at least an all-time high, going all the way back to pretty much the GFC. And in 2023, we're right about the same level. And I would assume that in 2024, you'll see the exact same thing. Why are they doing this? Well, because we have more geopolitical risk, we'll call it. When Russia invades Ukraine and the United States thinks it's a good idea to go ahead and freeze the assets of the Russian central bank, well, all the other central banks around the world see that. And they say, well, maybe I'm in good terms with the United States right now. But in 5 years, 10 years, who knows? So I need to de-risk. I need an asset on my balance sheet with zero counterparty risk. So I'm going to go ahead and buy gold. And once the gold goes onto the balance sheet of XYZ Central Bank, it's basically hodling. And you're taking that float out of the market, and therefore, all else being equal, the supply for sale moving forward shrinks, especially if the miners aren't producing as much as they usually do. And on the topic of Bitcoin, let's look at a chart of the price and the quote-unquote hodl wave. And this is really interesting. I got this from my good friend Lynn Alden the other day. And the orange line represents the percentage of people that have owned their Bitcoin more than a year. And the black line represents the actual price of Bitcoin. So the percentage is on the left, the price is on the right. And we can see, we'll just go back to, I guess this is 2012, around that time. The hodl rate was right around 25%, and it goes up and up and up until we get these big price spikes where the whales are selling into those price spikes, and therefore you would expect the rate to go down, the hodl rate, if you will, and then the price follows suit. And you see this cycle every single time. But what's interesting is the percentage of Bitcoin owners that are holding it long term are increasing with every single cycle, to the point today where it looks like close to 70% of the people that own Bitcoin have held for more than a year. So if these psychological dynamics continue, especially when you combine that with the halving that's coming up, which is going to decrease the additional supply of Bitcoin coming onto the market, you can see how this asset is primed for even more volatility moving forward than what we've seen in the past. Oh, but wait, there is more. Now let's go to everybody's favorite asset class, or maybe outside of real estate, the stock market, the S&P 500. And I rarely ever hear people talking about this, but it's so crucial that it's something that if you understand, it'll definitely give you an edge moving forward. So going back to the GFC, we saw the total shares outstanding for the S&P 500 right around, we'll call it 307 billion. Now this shoots way up, as you would expect. Why? Because all these corporations are selling stocks out to the market because they need the liquidity, which exacerbates the downside that we saw during the crash of 2008 and 2009. But since 2011, what have these same companies been doing? You guys know the answer. They've been buying their shares back hand over fist. So the more shares they buy back, the lower the float for the overall S&P 500 as a whole, to the point where we get all the way down just prior to the cerveza sickness. We're at a low, even going back before the GFC. Now, in 2021, it's started to go up, but since that time, it's trended lower. I don't have any of the data for 2023 and 2024, but I would imagine we would see the exact same trend. Why? Why not? If you were a corporation, wouldn't you be buying back your shares? You've got the banks that are throwing money at you, even though they won't lend into the real economy, and you're looking at the actions of the central planners saying, look, if I get in trouble, they're just going to bail me out anyway. So why would I not borrow all this money to buy back my shares to reduce the float? Because theoretically, if demand stays the same, and that's a key we'll get into in step number 3, the share price should continue to go up. So we're seeing the low float effect in real estate, most likely in gold, definitely in Bitcoin. We're seeing it in the S&P 500, and I would argue that moving forward, we'll continue to see it in pretty much all commodities due to things like the ESG narrative. And this is why I think we have gone into a volatility super cycle. Step number 3, how on earth do you manage your portfolio if we are going into this very tumultuous time, this volatility super cycle? And I know a lot of you right about now, especially after step number 2, are saying, oh, this is fantastic. The supply of every single thing I own is decreasing based on what George is saying, and therefore the prices of the stuff I own are going to explode higher. I'm going to get rich. Not so fast. You have to remember that the low float effect we talked about in step number 1 cuts both ways. You can see that price explode to the upside, but you can also see it crash to the downside. Let's look at a chart, another hypothetical, going back to 2020 all the way to today's date, pretty much the same one we used earlier, $0 to $5. It is the XYZ Corporation. Now, let's assume back in 2020, the price is, I don't know, right around 50 cents, something like that. It just goes up and up and up and up to the point now where it's almost $5. Most people would look at that and say to themselves, wow, this is fantastic. The price is at an all-time high. Therefore, the demand must also be at an all-time high. Maybe, but maybe not. So if the price is going up, demand can still be going down. How on earth does that work? Well, we saw a perfect example of this in 2020, 2021, 2022, when the government locked everyone in a cage, shut down the economy, and therefore we likely had demand go down, but we saw commodity prices rip higher because supply went down to a greater degree than demand went down. And in that environment, your price is still going to go up. So let's get a visual. Green represents the share price of XYZ. Red represents demand. It's going down to a point where it could be at an all-time low. But supply, represented by this blue line, has gone down to a greater degree. So this puts the person that owns XYZ in a very precarious position. You see, they're sitting back thinking that, number one, they're a genius, and maybe they are, maybe they're not. Maybe it's just simply the dynamics of XYZ buying back all of their shares. So this individual is sitting there popping the champagne bottles, but what they don't realize is if there comes a point where supply goes up even just a little bit, it's going to have a huge negative impact on the price because demand is at an all-time low. So how on earth do you manage your portfolio? Well, I can't give you any individual investment advice, but what I can tell you is what the pros do. And when I'm talking about the pros, I'm not talking about the guys and gals that are doing it right now, the people who have, quite frankly, never seen a recession. They've never seen a business cycle. I'm talking about the OGs, the guys and gals that were doing this in the 1980s, or the guys and gals that have been doing this since the 1980s, the 1990s, maybe even some of them the 1970s. They have been there, done that. So I want to reference a book from the famous Wall Street legend, Marty Zweig. And if you read the Market Wizards books, almost all of those guys reference Marty Zweig. In his book called Winning on Wall Street, he's got 17 rules. I'm not going to go over all of them, but I would like to point out a few. Number one, trend is your friend. Number two, you've got to cut your losers, ride your winners. Seems easy and it's simple, but in practice, it's very hard. And the third, and probably the most important, is if you can't sleep at night, reduce your position size or get out altogether. And a bonus that I'll throw in that Marty didn't talk about is moving forward, it's not just about having diamond hands. It's more so about having an iron stomach. Because if I'm right about us heading into a volatility supercycle, most people don't have the emotional discipline to handle the price swings. So inevitably, what ends up happening is they buy at the wrong time, sell at the wrong time, and end up losing money. So the main takeaway is if you want to manage your portfolio properly, you're going to have to go back to the future. You're going to have to get in that DeLorean and go back to 1980, 1990, or you can just go back and read all of these incredible books where the legends share their experience and their wisdom so you can reduce your learning curve and not only survive what's coming in 2024 and 2025, but actually thrive.